Hello, everybody. I think I'm going to wait just a minute here for this to catch up. Once again, my name is Stephen Meade. I am the broker owner at Domicile real estate for people who love houses. And we are back for a weekly update on the market. This is something we started doing, and we started tracking the actual results. And just to kind of preface this, if this is your first time with us, these are housing market updates for Southern California. We actually define for our Southern California market, that means Los Angeles and LA counties. Yes, I know Southern California is a lot bigger than that, but that is the area that we primarily work. So these are results and data for Orange County and Los Angeles County. And as before, I think we always give this data, but what we're trying to do is answer a couple questions for you. Things like, is it a good time to buy? Is it a good time to sell? Is the market crashing? Are sales plunging? What are the trend lines? What are we seeing happening? And the reason why we do these on a weekly basis is because what we're trying to do is really give you up-to-date information. I think a lot of people, a lot of the results that you see coming out, they're like, what did the housing market do last month? Well, if you're a buyer or a seller or a first-time home buyer, you don't care what the market did last month. Last month was a whole nother universe compared to now. Anyhow, I'm going to open up with something that I took a look at over the weekend. So I'm going to go ahead and do a screen share here and kind of go through, and I have some slides prepared as always to kind of go through everything for you. So I don't know how many people read the LA Times, but this was a headline that I was greeted with over the weekend. Southern California home sales are plunging. Prices haven't followed, yet. So I always kind of find, there's an art when you're selling newspapers to creating headlines. You want people to click on your newspaper article there. And I think the Los Angeles Times has done a very good job of that, kind of creating something that makes you want to know more. I'm not sure I entirely agree with the neutrality with where they're coming from there. It's not a dishonest headline, but I don't think it really kind of tells the whole truth either. The article is actually pretty good, and they talk about a lot of the same things we've been talking about for the last couple of weeks. But something else that I want to mention to you is that one of the things I don't do in here and that I don't have a slide for is I don't talk about closed sales. And there's actually a really good reason for that. It's not that I'm intentionally trying to withhold any information from you. But last week we talked about there's really three kinds of data when you're working with real estate data. There are trailing indicators. So a trailing indicator is something that tells you about what's happened in the past. So actually home sales closings are a great trailing indicator, right? Because they are talking about people that probably were looking at houses 6 weeks ago, put an offer in on a house 4 weeks ago, and have just recently closed. So I think home sales are a trailing indicator. Then we have present indicators, right? And those are things that tell us, kind of give us an idea of what's happening right now, like how many new homes came out of the market. Well, that's a present indicator that talks about how much inventory do we have. And then we have, the ultimate indicator, which are predictive indicators and leading indicators. So these are ones that tell us about things that are going to happen in the future. So for example, if new escrows are up this week, that means in about 30 days, what's going to happen to home sales? They're going to go up too. So that would be a leading indicator. And the problem that I have is I think that trailing indicators like home sales are not really that great because they say a lot about what happened 4 to 6 weeks ago. And unfortunately, that data just is not terribly important to me. I don't think that data is necessarily great for making decisions. If you are looking forward, like what should I do? I think trailing indicators are kind of limited value to you. And of course, right now, there's also a whole lot of problems with using home sales data because some of those contracts were before stay-at-home, some of those contracts were after, and it's really hard to kind of sort through that data and make sense of it. So I'm kind of choosing present or leading indicators only really to take a look at what is going on in our market. So without further ado, I'm going to go ahead and I'm going to go through our slides, and then I'm going to talk a little bit about lending because I think lending may actually be something that maybe you're hearing a little bit about, and there's kind of some news there that is sort of important. In fact, it's not sort of important, it's really important. So let me bring up the slides here. And we're going to kind of go through the data for this week like we have done in the past. So here we've got our new listings. And, last week, if you were watching, we had a really interesting spike in new listings under $1 million. They were, maybe down 25% from sort of our early days of coronavirus, but definitely before the stay-at-home order. And this week, those have retreated a little bit. So, they're still more than they were 2 weeks ago, but they're not really at the, they're not nearly back at the levels that they were sort of pre-coronavirus in that under $1 million category. Once again, this data is for Los Angeles and Orange counties, and we have divided it into under 1 million and over $1 million because I feel like those markets are very different. They have different buyers. They have a lot of things about them are very different. And so if we go over to our over $1 million category, we're actually seeing a pretty steady number. They're riding right around that 50% level of new listings from what we were sort of before any of these stay-at-home orders, before all these things. Moving on, we've got the other side of the equation, right? If new listings are a good measure of what's going on with supply in our market, new escrows are a good example of the demand side of what is happening. And I think this is really kind of where there's the story. I'm going to start with the over 1 million because I think that's important. Those numbers are just kind of hanging out really in the same spot. They're not changing a whole lot week to week. I think we've kind of settled in, and I hate when people use this term, but I'm gonna say it. We've kind of settled in to a new normal with that data and that over 1 million category. And we do have a little bit of interesting news on that I think we're going to kind of follow up with here. But the bigger story is probably what's happening in our new escrows in our under 1 million category. So those also dropped from last week, but they didn't drop by nearly as much. And that means, but we also have 2 weeks in a row where we have actually risen from sort of our low point. And, I want to wait another week before I call that a trend. But I think, the term that a lot of people in the industry are using is that we bounced off of sort of a bottom in terms of number of new escrows. These are people who have their offer accepted on a house, new escrows opening up in the past week. And we've actually seen, I think this is encouraging news. Like I said, I'm not entirely sold on it being a trend yet, but it's starting to look like a trend. And now I'm going to get to probably the most important graph. I think this is the one that really tells us a lot about our relative health of our market. And there's kind of a lot of stuff going on in this space. And I'm going to start with our over 1 million category. We've been kind of seeing some steady drops in this absorption rate. And again, absorption rate is that ratio of new escrows to new listings that are coming on the market. So how much of that new inventory is being taken up by buyers? Is our inventory levels growing or are they falling? And I think that's really important to understand. One thing we don't include in here is homes that have been pulled from the market. So for example, somebody might put their house on the market and pull it after 2 weeks. We're not really accounting for that in the data. So you can still have a shrinking inventory market, even though your absorption rate is less than 100%, because listings go away for a lot of reasons other than somebody buying the house. What I think is really fascinating, though, switching to this under 1 million category is, last week we saw our absorption rate take a dive. I mean, over a 10-point drop. And I think when you do that, you see kind of some concern, right? The concern is what is going to happen to prices? Where are prices going to go when we see that absorption rate drop? Because absorption rate, a lot of people think is a leading indicator of future prices. So, absorption rate means demand is falling. Where do prices go if demand falls and supply stays the same? Guess what? Prices tend to go down. So we were wondering, are we seeing the start of a trend? And it looks like last week was a bit of a blip on the market. And the reason why I say that is we look at where our absorption rate is this week. And, it's a drop from, of course, our peak absorption rate, back in the beginning of March. And it's a drop over those first 2-week measurements, but it is an increase over last week. And if you are looking at this graph, I think something really important to kind of take note of is you can kind of draw a trend line in this under 1 million category. And it looks like this is a pretty steady situation that is happening with our absorption rate. And we're not really seeing, big changes happening. And even in the over million, you kind of have a bit of a trend line going there as well. These aren't huge moves to our market. Before I move on to the next slide, I want to take a little bit of a minute to discuss kind of data and understanding this stuff. And, this is something that I think agents almost very rarely say. And I think it's something that agents and realtors and brokers and even economists really need to tell people a little bit more often. And that is, economics is sort of an art. It's the science of making educated guesses about money. I mean, that's really what this stuff comes down to. And I think none of this is certain. And that's the reason why we review this. If I had a certain outlook for a month from now, I wouldn't need to do market updates for the next 3 weeks, and you wouldn't need to watch them because the data wouldn't change. We would know what's going to happen, but we don't, right? And that's why we kind of look at this data week over week over week, because it lets us compare what's happening, what we thought was happening, and see whether our estimates and our predictions are correct. And I mean, the good news is largely, these numbers have been fairly steady over the last month and a half or so, 2 months. We're not seeing big changes in our market. We are seeing, as you might predict, we probably will see sales definitely will drop in terms of the number of sales, the number of houses changing hands. I mean, that makes a lot of sense. New listings have dropped and new escrows have dropped. What do we think sales are going to do? Well, guess what? They're going to drop too. But the question is, what's the health of our market? Is this a plunging market in both number of sales and price, or is this just a market that suddenly has a lot fewer properties changing hands? And I think really it's more the latter. At least that's what the data is showing us this week. So I'm going to head back here and I'm going to show you kind of the slide that you've all been waiting for. And, we made a couple changes to that slide this week. And this is our average new escrow list price. So I've said this a couple times before, and that is, we don't know the price that a property is in escrow at until it closes. And that's really unfortunate because this is the most up-to-date data, right? These are people who negotiated and signed a contract in the last week. So what they are doing is the exact present market data. This is the right now market data. But we can kind of approximate that by looking at what the list price was, right? So, on average throughout a market, we might say properties are trading at 98% of list price, but we can watch that list price over time and make comparisons. And what I've added to this graph was I've actually added labels for the numbers. And what's really cool here is, let's start with this under 1 million category. And we see that in the beginning of this, we were at a 611 median list price. And that's very healthy. Then it dropped to a 602, then a 597. But then starting last week, we saw things go up, right? And going up is, very encouraging sign if you are thinking of selling your house, because it means prices aren't going down. It looks like they are going up. But 1 week differences don't really indicate a trend. So I know I was really excited to see the numbers for this week, because that means we have 2 weeks in a row and we're a little bit better with a trend. And guess what? Our median list price now has gone to 609, 627 for these under $1 million properties in Los Angeles and Orange County. So that means not only have we had 2 weeks in a row where we have kind of gone back up from our low point of 597, we were actually almost at that first week number. We are almost exactly at that point of trading where we were nearly 2 months ago on this, or at least 5 or 6 weeks ago. And I think that's very encouraging. I think that tells people that I'm not inclined to give sellers advice of, you definitely must list your house now, or no, you definitely should not list your house now. I think this is in the range where it's really a lot more about your individual scenario. This is, I'll go over the pros and the cons for you really quick, and you can do a little bit of a self-assessment. If you are a seller If you have a place that you would like to buy, I will tell you now is a pretty good time to put your house on the market. Number one, prices have not slid, so you're not really giving much up. And two, we know where interest rates are, and they're in a very good place. I can't tell you where interest rates are going to be in 2, 3, 4, 5, 6 months. So if you are a person who does not like your home or you are looking to make a change, I would say now is as good a time as any, especially if you have some security about your job. If you are a buyer, it's kind of a similar story, right? For you, it's very much about your individual scenario. If your employer is furloughing employees right and left, now is probably not a good time for you to buy a house. However, if you are a first-time home buyer looking to enter this market, well, I think the fears of a plunging market are kind of unfounded. I think you're going to have a little bit less competition looking at those houses. And I also think you know that you're getting, again, your interest rate value is going to be pretty good. You're going to be looking at those low interest rates, and that really makes a big difference. I don't have a graph for this, but I think it's something important to talk about. Affordability is actually up versus where it was, a year, 18 months ago. And the big reason is these lower interest rates. It means these lower interest rates have more than countered out any price increases in homes. So if you are a person looking to get into the market, you're in a better spot to do that today than you were 12 or 18 months ago. But again, it goes back to your personal situation. Looking back here on our graph, if we look in the $1 million range, we have something kind of interesting going on. Our median price is jumping. And does this mean that we think properties are going up in value in the over $1 million range? Not necessarily. And I'm going to tell you why, especially for this high price range. The under $1 million market is fairly homogenous, meaning there's a lot of tract homes, there's a lot of sales in general. The sort of luxury million plus market, though, there's not nearly as many sales, our sample size is smaller, and this could indicate that not so much that the prices are going up, but that the types of homes that are selling are more expensive homes. And if you think about that, that narrative actually makes a good amount of sense. Something that we see in our market, that I've noticed over the years when we have, recessions and things like that, is that the sort of, I call it the entry-level luxury market, so the $1 to $2 million market. These are buyers that are still working for a living. They're not independently wealthy. They're more likely to be high income earners. That market is a lot more sensitive to the economy than the $2 million plus market, which seems to be based more on net worth and long-term wealth. Those people are in a much better position to be making home purchases right now. So I think we're seeing more movement in that price range. If anybody is super curious about that and wants to see some more detail, stratifying that luxury price range, I am happy to do that for people. But I have a feeling the reality is that, most of us that are watching this podcast are probably in the 1.5 million and under markets. Just mathematically, that's the way the distribution works. Kind of moving on here to our next slide, we have our days on market for new escrows. And one of the things I kind of love about this graph is that this is something that's very easy to understand. Sellers ask me, how hard do you think it will be to sell my house? How long will it take to sell my house? This is the #1 question that we get. And we have the data right here. And the data is that on average, if you're in this under $1 million range, guess what? You are better off than you were 2 months ago with this. You actually have a better chance of selling your house. And what this is kind of showing to me is we're seeing a sort of stratification in our market. And let me explain what I mean by that. What I mean by that is, and I don't have a slide for you, but I will bet anyone $100 this is true, that the more attractive properties are going faster than they were going before, and the less attractive properties are actually taking longer to sell. And that explains why we can have an absorption rate that is going down, but so is days on market, meaning, properties are selling faster. And it just means that, there might be a much bigger difference between those attractive properties and what performance they're seeing in the market and the less attractive markets. And honestly, anytime we see a reduction in demand, even when it's with a reduction in supply, we kind of notice that trend. People flock to quality. People flock to looking at going and buying the houses that they really want, not the ones that are just sort of there and to get a house. Right now, people don't want a house. They don't want any house. They want a house that they actually feel some sort of attraction to. Finally, before we end this week, I want to talk a little bit about lending, because I think this is very important depending on what kind of market you are in. And most of you probably have had money in the stock market. You've been sort of watching, kind of some crazy volatility, right? The stocks go up, the stocks drop quite a bit. And believe it or not, there's been something similar happening in the bond market. And the bond market is really sort of what controls interest rates. It's not the Fed, it's the bond market. And we saw a lot of people just pulling their money out. So they were just saying, I don't want to be in the market at all. I just want to hold on to my cash as tightly as I can because the market is so volatile. And the problem with that is, while that doesn't necessarily affect conventional mortgages, what it really can affect are jumbo loans as well as alternative documentation loans. So loan programs that are for first-time home, or not for first-time home buyers, for self-employed borrowers, where they look at your bank statements instead of your tax returns, or jumbo loans, ones that are for homes that are in these upper price ranges. And just to give an example, you can actually buy a home up to $800,000 in LA and Orange County for 5% down using a conventional loan. So we're talking about houses that are above this $800,000 threshold. There's been some tightening. It's been harder to get loans. And we've seen some lenders kind of just pull off on doing fundings in those loan categories. So conventional loans, conventional high balance loans, you are good. There's not really been a lot of disruption. But some jumbo loans, other than big banks, and some of these very specialty type loans. But there's some good news on that front. And I think the good news is this. We are already seeing some of these specialty lenders that sort of paused operations for about 30 days. Some of them are starting to come back, and they're starting to do loans again. So we're kind of seeing a thawing of that credit market. People are less freaked out. They're willing to put their money back in. And that's really seeing an improvement on it. I'm trying to think of a way I can graphically illustrate that for kind of next week's update to kind of show you what's happening. But generally some good news on that. As always, we love your questions. We want to see what's on your mind. We're happy to answer them. And if you have sort of an individual and a more private question, definitely reach out to us. And we will see you next week. Signing off, Stephen Meade with Domicile Real Estate for people who love houses.